In this week's Property Insider Chat, Dr. Andrew Wilson and I reflect on the year that's been in property and economics and suggest some trends that will affect our property markets moving forward. And one of the big ones is that I see 2023 as a year that our property markets will reset. There's going to be a trough and it'll beginning of the next property cycle as buyers return. And you'll hear Dr. Andrew Wilson's forecasts for where he thinks our property markets are going to end in 2023. So if you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can let you know each time a new show comes out. It's hard to believe that the debate about whether unvaccinated Novak Djokovic should be allowed to play in the Australian Open was only this year. What a year it's been. What a remarkable year it's been, and especially for those in our property markets. This time last year we were talking about experiencing record low interest rates. And remember, the Reserve Bank told us they wouldn't raise rates, well, at least until 2024. No one had a clue that there'd be a war in Russia and Ukraine that would create international tensions and fuel international inflation. In fact, nobody had the idea that inflation in Australia would finish 2022 in the region of 8%. But here we are, and considering all the challenges thrown at our property markets, including floods, a federal election, and the media intent on telling us the markets were going to collapse, our housing markets remained remarkably resilient. Now, it's customary at this time of the year for Dr. Andrew Wilson and I to reflect on what's transpired and then use our perspective to share with you a number of trends that we see will shape our property markets moving forward. So I'm looking forward to today's Property Insider Chat with Dr. Andrew Wilson, Australia's leading independent property economist. Hi, Andrew.
G'day, Michael, and we've come to the end of the year, another year, and the word topsy-turvy comes to mind to describe 2022 in more ways than one. As you suggested, if it's not just economic policy that was on a roller coaster ride, it was also our housing markets, which usually is the same cause and effect environment. But I think we can look forward, fingers crossed perhaps, Michael, to a steadier year in 2023.
I think so. Look, our property markets really didn't unfold like many people expected, either on the upside. Many started 2022 very optimistic, coming out of a boom, or on the downside, as many property pessimists in the media predicted. None of those occurred either. I guess it's been said that if you look at last year's forecasts and see how wrong they were, you probably wouldn't put much store in this year's forecasts. And currently there's no shortage of people telling us what they think is going to happen in 2023. First of all, I think it's important to understand the inherent limitations of forecasting, considering the huge impact that human behaviour seems to have in our housing market. And then there's the impact of all those external factors, natural disasters, which we've had our share of, political events, technological advances, and the impact of all these things on the property and economic markets. But let's have a talk about a couple of trends I believe will impact our market. And I agree with you. To start with, Andrew, you said next year will be less topsy-turvy. I think it's going to be a reset year. I think we're going to reach a trough and it'll be the beginning of the next cycle as buyers return into our markets.
Well, we'd sort of headed to that position, Michael, in 2019. We'd moved through a lot of boom and bust environments, and I use those two words advisedly. And we looked to be getting to the point where we did have inflation under control, where we were entering an environment of moderating price growth, so that the peak and trough environment was flattening. And I think that was the outlook. And of course, as you suggested, human nature, evolution, whatever you want to call it, from left field came COVID and completely changed the whole box and dice. And of course, we're now playing with a new economy and a new outlook as a result of COVID. And we've basically moved back into the reverse of where we were prior to COVID, with high inflation and booming economic activity feeding each other. It's remarkable how things can change and how the outlook can be completely different. But I just want to say one thing, Michael, just adding to your comments regarding the forecasting, and I'm not going to give any great detail, but it must be a little bit sobering, given all those forecasts that we have had this year, that 2022 will actually end up being a better year for the housing market than 2018, which was the previous downturn period we had, which was an adjustment period following a strong boom in 2017. but we're actually going to have a better results in terms of prices, Michael, across the board this year than we had in 2018. So not only have we not had a crash, we've had a better performance in terms of comparing ourselves with the previous downside.
You're right, Andrew. The Australian Bureau of Statistics, who I guess Australia's official statistician, recently released figures showing that the median price of established homes in 6 out of our 8 capital cities ended the year higher than they started. And the median price of houses in many of Australia's regional cities is much higher than it was at the beginning of the year. So those forecasts of the overall market slumping, they were really wrong, weren't they?
They were, and even Melbourne and Sydney, which are the markets that suffered the most this year, were the markets that prospered the most over the previous 2 years. So it was an adjustment process. And of course, Melbourne was hindered by very severe lockdowns. I still think there's some pent-up demand left in the Melbourne housing market that'll push it even higher next year. But yeah, look, it was just cheap headlines, and it's becoming almost ludicrous, the trawling out of these predictions of house price crashes and how wrong they are. And again, remarkably, it's the banks that seem to be leading the charge in terms of getting it wrong. But, next year's another year. This year has proven to be, as you said, a resilient year. And I think we've got all the positives to be moving forward next year. But again, we just don't know what might come out of left field. And that's the one thing we can never predict.
That's right. Having said that, though, it's likely that inflation will peak in the last quarter of 2022, but we probably won't realise this until all the stats come through in the first or second quarter of 2023. I guess we're going to be living with a level of high inflation for a number of years. It's not going to drop to within that target range of 2 or 3% for a couple of years, will it?
No, I think there's a couple of forces at play here, Michael. Firstly, we have had a reduction in inflation recently. Certainly the US and the UK are now their headline inflation is lower. But when we look a little deeper into why it's lower, it's certainly been driven by a significant fall in the price of oil. And it is the lower petrol prices that are certainly improving headline inflation. But when we look at underlying inflation, Michael, which of course takes out the volatile elements such as food and fuel, we can see there's really not much change in underlying inflation. And it's the underlying inflation rate that central banks use as their guide. And that's where they're looking for that 2 to 3% range to get into. I think that's going to be almost an impossible target. It's looking like the reverse of trying to get to the 2 to 3% range 4 or 5 years ago, which was proving to be impossible. I think the only way we'll get to that 2 to 3% target, Michael, is to create significantly higher levels of unemployment. I'm going to ignore the recession benchmark that we tend to be using when it comes to controlling inflation. I mean, we could have a technical recession and still have low unemployment. We unfortunately, to get to that target range, I believe would need to have around about, I think at least double the unemployment rate that we have now. And that would cause obviously significant stress. I'm not sure that governments have the political will now to do that, Michael. I think that we're already seeing signs of that in Australia's government with their interference or their policy changes to wage setting. I think that they're looking to the electorate in terms of the short-term positives rather than try to fix those long-term problems with high underlying inflation.
Well, as we look at trends that are going to affect our property markets, yes, inflation is going to come under control, but will remain high. And I think interest rates are going to peak. Now, a lot of people have spent much of this year trying to predict what the Reserve Bank's going to do with interest rates. I don't think they know, because each month they meet and they're not sure, should it go up by 0.5%, by 0.25%, not go up at all. But I think there's going to probably be 1 or 2 more increases. They're trying to find that neutral level, Andrew. And when they do, and when people realise that interest rates aren't going to go up, when there's a couple of months of no interest rate rises, when they realise inflation's under control, the pent-up demand that you're talking about is going to reset the markets. I think 2023 is going to be a year of reset, the beginning of the next cycle. Not a boom, but just the market's going to move on?
Well, I think affordability will be the issue, Michael. And
Yes.
affordability will match incomes and the labour market and all those factors which generate the capacity to purchase a property. I think that we've still got a few interest rate increases left in the gun. I'm not sure that force will be enough to actually quell demand. We've seen that this year, that other than some sort of changes to confidence and sentiment early days when interest rates increased, I think by and large the market has shrugged it off and moved forward. And that's why we've sort of got this new reality that people are looking to offset the impact on affordability from higher interest rates with higher wages. And when you've got a job and there's lots of competition for your labour and you have the capacity to push your wages up because of that competition, you look to offset your increased costs. You improve your household balance sheet. I think that even with higher rates, this is the point, that we'll be able, and perhaps we'll, won't have the constraints that we've had previously in terms of the capacity to push our wages up. And this is obviously going to continue to fuel inflation. So there'll be some big decisions next year from the Reserve Bank, Michael, and from governments. And I'm not sure governments have the political will to do the hard yards that we did back in the early 1990s and in the 1980s as well, to be able to slam the brakes on and create the sort of stress that does impact the economy with. And I think that we'll be living with higher inflation and higher interest rates for some time, but I'm not sure that's going to impact the real issues with the housing market. And that's that we just don't have enough houses for people anymore.
The shortage is a big issue, which I'd like to discuss with you in a moment. But we keep talking about higher rates, but it's higher rates compared to those wartime stimulatory rates that we needed to get us through COVID. Andrew, isn't this more the normal sort of rates that the Reserve Bank's always wanted to sort of get the rates to? Which means if we have challenges down the track, whether it's another pandemic or recessions, whatever, they'll have the ability to lower rates. They can't stay at wartime rates forever, can they?
Well, it's all a relationship matrix, Michael, between the interest rate and the rate of inflation. And that reflects the labour market activity of employment and unemployment and how that relates to income. I mean, we could live with a higher interest rate if we have a higher income. If we have a lower interest rate, we typically have a lower income. So it's how those things move together that's important, not so much the absolute measure. And as you said, in a relative sense, I mean, 3 or 4 years ago, we had a 1% or very low interest rate, but we had very, very low incomes growth. And that was the problem in the economy. Now we have the reverse. We have a higher interest rate, but we've got higher wages growth as an offset to that. So it's a matter of finding at least a position where the balance is there between people having a job and having real incomes growth. And that's what the Reserve Bank has to strive for. But unfortunately, there's a lot of co-conditions to that are difficult to manage, not the least what's happening overseas.
Well, that's right. And that's an unknown, isn't it? Who would have thought in February when the war in Ukraine started that we'd still be talking about it now? Who would have thought that we'd be talking about another strain of coronavirus? Andrew, apart from house prices, there's also been a rental crisis, which looks like it's going to worsen because of lack of stock and immigration rising. There's recently been some immigration figures that have surprised on the upside.
The fundamental issues will move beyond affordability in relation to interest rates and incomes. It's just that there's a significant shortage of property in this country, whether you're a tenant or an owner-occupier. It will mean you're having to pay higher prices and certainly higher rents going forward. Our latest data, Michael, even end of the year data, which is affected by seasonal factors, of course, in the rental market, has, as an example, Sydney's median rent for a house now pushing towards $700 a week, which is obviously a record, but it's after a period of flat rental increases for houses in Sydney. It's now taken off over the last 2 months. And this is just another sign, perhaps, of the impact of migration coming into the marketplace on rents. This isn't just a Sydney problem, it's a problem everywhere. And the only way, other than a really deep recession where people just hunker down and start to live with other groups, the only solution is more houses. And we certainly don't have any prospect of improving our supply side in terms of offsetting the shortage of housing that we have in this country. And that's going to be with us for the foreseeable future. And it's the same problem in many cities in the US as well, Michael. I don't think there's any solutions to this other than perhaps to avoid the rental market if you can.
Well, that's going to be hard for first home buyers because they're going to be affected by higher cost of living and higher rents. And that's why I think our markets are going to be more fragmented because, as you correctly say, affordability is going to be an issue for many, but not for others. There's still going to be people with high disposable incomes, with multiple streams of income. And there's also going to be a good opportunity, I see, for upgraders as the upper end of the markets experience larger price declines. And there's a lot of people who have bought their home 10, 20, 30 years ago and got quite some equity. So there are still opportunities for upgraders, and there'll also be good opportunities for investors in 2023.
I think the positives for home ownership are increasing as a result of the change in our big picture. I think that, home ownership is going to be even more of a necessity than it has been because of the squeeze on the number of properties that are available. And I think that means that people will strive, whether it be for investment property or owner-occupier, to maintain their position in the marketplace. And there's even more incentive for first home buyers to get into the market. And I think that'll be reinforced even more next year. And it'll be the old mantra of bricks and mortar, safe as houses, that'll come to the fore. But I think that's becoming even more of a positive with the change in our circumstances, with higher inflation, higher interest rates, still a strong economy, but a very weak supply line of new housing coming through. And of course, at the other end of all that is another surge in migration. After our border turned off the tap, we're now back into full mass migration mode. And, they've got to live somewhere, Michael.
On balance, the fundamentals for Australia's property markets are stronger today than they were, I guess, 3 years ago before that big property boom. But the media keeps focusing on the negative headlines about the inflation and interest rates. If you think about it, this time 3 years ago, we had a national unemployment rate of around 5.3%. Today, it's 3.4%. We've got officially the lowest unemployment rate in 70 years. But Andrew, apart from all those jobs that currently exist, I just had a look, and the Australian Bureau of Statistics suggests there are 470,000 jobs looking to be filled that are advertised at the moment, no people to fill them. So Australians should probably feel more secure than they ever have in their jobs. And now, in the first time in a decade, there's significant pressure underpinning wages growth. So if we also look at other good, strong fundamentals, Australians have got more equity in their home than they've ever had. They've squirreled away billions of dollars into offset accounts and prepaid their mortgages. In fact, Australians are wealthier than they were 3 years ago before COVID. So despite all this, though, consumer confidence is at historic lows. And I guess that's one of the things that's been dampening our property markets.
The consumer confidence measures, Michael, tend to be putting that cart before the horse to a large degree, or the horse before the cart, however that works. Because I think people just say what they think they should say in those surveys, and they don't necessarily reflect what's happening in the real economy. And I'm reasonably dismissive of consumer confidence measures because you look at the real measures of confidence and that's what people are spending. Even though we had a slight downtick in retail sales over October, they're still massively over $30 billion a month and well ahead of where they were pre-COVID. And the people are still spending willy-nilly. And of course, our housing market's picked up despite all the negativity through the spring selling season. It doesn't make sense, those consumer confidence measures, when if people weren't confident, why would they be out there spending like they've never spent before and also re-engaging the housing market in an environment where affordability is falling? And there's plenty of nonsensical headlines still about crashing house prices.
Well, if we look at some more predictions, forecasts for 2023, I think in due course over the year, the media is going to change its rhetoric. Well, I hope it does. And it's probably going to stop scaring us about inflation and interest rates, because how often can you run that story when things are under control? But maybe they're going to look for a new bogeyman. Is it going to be a recession overseas they're going to keep scaring us about?
Well, I think that certainly the measures of economic activity, which give us that word recession, which is GDP, will perhaps translate into 2 consecutive quarters. They're sort of thereabouts now in the UK and the US, and it's a great headline. But unless it's followed by steeply rising unemployment, it really doesn't affect anybody on the ground unless they're losing their job. If we still got low unemployment and wages are rising, well, recession's just a word. Now, the
Yes.
last recession we had, the last real recession we had, because the one we had in 2020 wasn't a real recession. It was just an adjustment through COVID. But the last real recession we had in the early 90s, I mean, we had double figure unemployment then as well. And that was a real recession because not only did we have 2 consecutive quarters of negative GDP, we also had skyrocketing unemployment. And I'm not sure we're anywhere near that circumstance going forward, even if we did get 2 quarters of negative growth. And I'm not sure we'll get that in Australia anyway next year. But as you said, Michael, I'm sure if we get those recessions in the US and the UK, and it will have an impact on Australia's economy, particularly our resource sector, our export sector, there'll be plenty of negativity, and that can have a real impact on investment decisions going forward. But I think the secret really is that why would you be reading the media anyway? Don't you want to know what's really happening?
Yes, I agree. As we said at the beginning, don't pay as much attention to forecasts and have a look at history. But I also think when we have a chat this time next year, it's going to be a year where home buyers and investors are going to look back at the year, and some will regret that they missed out upgrading their homes or making investment decisions because the market is likely to have bottomed. And again, it's not going to boom and we're going to have fragmented markets, but we'll move to the next stage of the cycle.
Yeah, I think we're a quarter away from the Melbourne market bottoming, Michael. Maybe a little bit longer from Sydney, but certainly in that same time frame. And as you said, we'll have reasonably incremental growth going forward because we don't have the capacity to push up prices with lower interest rates or skyrocketing incomes. But nonetheless, there will be a squeeze given the shortage of property. I don't think it's too much of a stretch to say that home prices will be higher at the end of 2023 than where they started. And I think in all capital cities, all major capitals at least, will have a year of higher prices in 2023. And I don't think that's too much of a heroic or optimistic forecast.
I don't think so either. Having said that, this is the way the cycle normally works. After the downturn, we don't move straight into a boom. We go to a stabilization phase. Buyers come into the market. Sellers who've been holding off, the discretionary sellers, start to get in the market because most sellers are then buyers again. And there's a period of equilibrium before certain segments of the market start to pick up. The boom is really the last stage of the cycle. It was just a very unusual cycle driven by pent-up demand, very low interest rates, government incentives a couple of years ago, Andrew.
Yeah, and a lot of that, it's the pent-up demand that is the real secret to the pent-up demand cycle. That's the secret to the sort of the boom and bust. We had more pent-up demand because of COVID lockdowns, Michael, because people actually physically couldn't go out and engage in the property market. So when the lockdowns, because of lockdowns, but when lockdowns finished, they were out and running. So you had all that built up, dammed up demand ready to be released. When it was released, of course, it meant strong prices growth. And we've had a similar episode this year, obviously not as significant in terms of the build-up of pent-up demand through the higher interest rate, negative headline environment that affected the market in winter, Michael. But I think that gradually buyers are returning to the marketplace. And as you said, buyers are sellers and sellers are buyers. And that will gather some momentum. And once we do have clear air, which is, of course, a similar circumstance to 2019, when the market was spooked by negative headlines in 2018, once we have that clear air, once it becomes more apparent that those forecasts were just ridiculous clickbait again, then people start to think about, oh, gee, I better get in here. And then we get the reverse, which is the fear of missing out, and that creates the next cycle going forward. We're going to get the end of fear of being involved, which was what generated the market this year with higher rates, and then we'll start getting the other end, which is fear of missing out, perhaps sometime next year, Michael, particularly in this chronically undersupplied market, and particularly when we've got 195,000 migrants heading for our shores this financial year.
I think it's probably worthwhile remembering how quickly the market can change. Just think about how quickly the market changed once in 2020. We realised that COVID wasn't going to be as bad as we thought. Think about how quickly the markets changed in 2019 after the election result. And so therefore, once people realise that it's not going to be as bad as the media tells us, it's possible that consumer sentiment and the market will change again, as you say. So it's going to be another interesting year, and I look forward to catching up with you in 2023 on a regular basis for these Property Insider chats, Andrew.
Yes, look forward to it, Michael, and look forward to what the year has in store and whether there are any more surprises coming along.